I like almost everything. just offer it to me and find out.
Berkshire Hathaway CEO and self-made billionaire Warren Buffett turned 90 on August 30th, 2020, and he's not slowing down. Warren Buffett's investment advice is timeless. I've lost track of the number of investing mistakes I have made over the years, but almost all of them fall into one of the investment tips given by Warren Buffett below. There's no better person to pick investment advice from than one of the best investors to ever live. We wanted to know what investment advice we could learn from Warren Buffett and put together this video. Enjoy! This is the biggest investment advice from Warren Buffett. But before we get into the video, don't forget to leave a like and subscribe to the channel with notifications turned on so you don't miss any of the new videos we post. Diversification is not always a good idea. Many good investors stress the importance of diversification, but Warren Buffett tends to disagree with the idea. Buffett says that diversification is for people who don't know much about investing. An experienced investor should choose stocks on a long-term basis and should have faith in his or her investments. Some investors diversify their portfolios because they are afraid of any one stock might sink their entire portfolio. But while doing so, it becomes much harder to keep track of the current events impacting each company. So by diversifying, they might reduce the volatility of their portfolio, but at the same time, they reduce their focus on individual investments. Buffett waits for opportunities to buy good stocks. When those opportunities comes his way, he takes full advantage. According to Buffett, when it's raining gold, put out the bucket, not the thimble. Invest in what you know and nothing more. One of the easiest ways to make an avoidable mistake is getting involved in investments that are overly complex. Most of us have spent our entire careers working in no more than a handful of different industries. We probably have a reasonably strong grasp on how these particular markets work and who the best companies are in the space. However, the vast majority of publicly traded companies participate in industries we have little to no direct experience in. That doesn't mean we can't invest capital in these areas of the market, but we should approach them with caution. Buffett says, "In my view, the far majority of companies operate businesses that are too difficult for me to comfortably understand. I'll be the first one to tell you that I cannot forecast the success of a biotechnology company's drug pipeline, predict the next major fashion trend in teen apparel, or identify the next technological breakthrough that will drive growth in semiconductor chips. These types of complex issues materially affect the earnings generated by many companies in the market, but are arguably unforecastable. When I come across each such a business, my response is simple: pass. There are too many fish in the sea to get hung up on studying a company or industry that is just too hard to understand. That is why Warren Buffett has historically avoided investing in the technology sector. If I cannot get a reasonable understanding of how a company makes money and the main drivers that impact its industry within 10 minutes, I move on to the next idea. Of the 10,000 plus publicly traded firms out there, I estimate that no more than a few hundred companies meet my personal standards for business simplicity," Buffett says. Peter Lynch once said, "Never invest in an idea you can't illustrate with a crayon. Think long term. If you're planning to invest in individual stocks, don't base your choice on which companies are performing well right now. Instead, consider which businesses have staying power. Nobody buys a farm based on whether they think it's going to rain next year," Buffett said in 2018. "They buy it because they think it's a good investment over 10 or 20 years. Buffett decides a business is worth investing in based on if he believes it will last. He's purchased See's Candies with longtime business partner Charlie Munger in 1972 and spent more than $1 billion on Coca-Cola stock in 1988, both of which turned out to be good bets and both of which he still owns today. Put together a portfolio of companies whose aggregate earnings march upward over the years, and so also will the portfolio's market value," Buffett wrote in his 1996 letter to shareholders. "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Invest in yourself first. The best investment you can make is in your own abilities. Anything you can do to develop your own abilities or business is likely to be more productive." Warren Buffett says that the best investment one can make is on his or her own abilities. Most people are not going to make most of their money from the stock market. They're going to make it in their careers. So put yourself first. Buffett's partner, Charlie Munger, had a similar thought. Munger's secret to success? Sell yourself an hour each day and use that hour to make yourself better. Investing in yourself is paramount to doing great things and applies to more than just investing. According to Paid Surveys USA, 75% of Americans invest in themselves first. Be patient. What do you think is the number one reason why most people in the world are poor and unsuccessful? Well, it takes time, crazy dedication, and unusual persistence to create wealth and success. You must patiently endure the tough times or you won't be able to go through the rough road that leads to success. Great things take time. You can't have a baby next month by impregnating 9 women today. Never compromise on business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high-quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Some investors might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. Berkshire was in the textile manufacturing industry, and Buffett was enticed to buy the business because the price looked cheap. He believed that if you bought a stock at a sufficiently low price, there will usually be some expected good news that gives you a chance to unload the position at a decent profit, even if the long-term performance of the business remains terrible. With more years of experience under his belt, Warren Buffett changed his stance on cigar butt investing. He said that unless you are a liquidator, that kind of approach to buying business is foolish. The original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. These types of companies also usually earn low returns, further eroding the initial investment's value. These insights led to Buffett to coin the following well-known quote: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." One of the most important financial ratios that I use to gauge business quality is return on invested capital. Companies that earn high returns on the capital tied up in their business have the potential to compound their earnings faster than lower returning businesses. As a result, the intrinsic value of these enterprises rises over time. Time is the best friend of the wonderful business, the enemy of the mediocre, said Warren Buffett. High returns on capital create value and are often indicative of an economic moat. I prefer to invest in companies that generate high 10 to 20% plus and stable returns on invested capital. Instead of giving in to the temptation to buy a dividend stock yielding 10% or snap up shares of a company by trading for just 8 times earnings, be sure you are comfortable with the company's business quality. Stay the course. It can be stressful when the markets tank, but don't panic and sell off your investments just because of the latest news cycle. The markets are always going to be volatile, and the best thing any investor can do, regardless of experience, is keep a level head, says Buffett. Though the markets are generally rational, they occasionally do crazy things, he wrote in his 2018 letter to shareholders. Instead, stay the course and trust that you've invested in companies that will stand the test of time. Investors need an ability to both disregard mob fears or enthusiasms and to focus on a few simple fundamentals, Buffett wrote. A willingness to look unimaginative for a sustained period or even to look foolish is also essential. Put simply, don't watch the market closely, as Buffett told CNBC in 2016 amid wild market fluctuations. Trust yourself to be a successful investor. Buffett says that the hardest thing to do is to trust your investment decisions. You always think that the others are the right and you are the wrong. Instead, you need to study and believe in yourself. To be successful, you need to overcome the fear and not pay attention to what others are telling you. Accumulate knowledge and make investment decisions on your own to stand separate from the crowd and be a winner. Choose your friends carefully. It's better to hang out with people better than you. Pick out associates whose behavior is better than yours and you'll drift in that direction, said Warren Buffett. One thing young people do more than anybody of any other age demographic is that young people associate a whole lot. Unfortunately, most people are not conscious of whom they hang out with. We have an important exercise for you. Stop watching this video and make a list of 5 people you spend the most of your time with. Close your eyes and imagine where these people are likely to be in the next 5 years. Sorry, that's where you're going. It's pretty simple. If your associates are not ambitious or positive about life, you can't be. If your friends don't know more than you, you're never going to grow and become a better person. So what should you do? Cut yourself off from negative and unmotivated people. Choose your friends carefully because you can't be better than whom you associate with. With those insightful investment tips from Warren Buffett, we have come to the end of this video. Feel free to leave a comment below. Thanks for watching, and be sure to check back for more, and until then, take care.